What if everything you believe about money is built on something you cannot actually see or touch? What truly gives your money value, and who decides whether it keeps that value tomorrow? You hold this piece of paper and assume it represents something solid, something real. But what if the foundation behind that paper quietly disappeared decades ago? Today, money moves as digital numbers, not physical metal resting inside a guarded vault. Your wealth exists as digits on a screen, supported entirely by confidence in a system. Those numbers feel permanent, yet their value depends on forces you rarely see. Because behind those numbers is not gold, not silver, but collective belief. To understand this, we must return to a time when money meant metal. A time when paper currency was simply a claim on something physical. For centuries, gold was trusted because it was scarce, durable, and universally valued. Gold did not depend on government promises, it depended on physical scarcity. Across continents and empires, gold functioned as money long before paper existed. When paper currency appeared, it was simply a receipt for stored gold. Governments promised that anyone could exchange those notes for gold on demand. After the devastation of World War II, global leaders wanted financial stability. In 1944, representatives from dozens of nations gathered in New Hampshire. This meeting would reshape the global monetary system for generations. Under the new agreement, the US dollar would be convertible into gold at $35 per ounce. Other countries tied their currencies to the dollar, placing America at the center of global finance. In the 1950s, America experienced strong growth, industrial expansion, and rising global influence. Factories were booming, exports were strong, and the dollar symbolized stability worldwide. Foreign governments began accumulating large reserves of US dollars for trade. The world increasingly depended on dollars to conduct international business transactions. But by the 1960s, rising military involvement in Vietnam dramatically increased government spending. At the same time, domestic social programs expanded under ambitious federal policies. To fund these commitments, more dollars were printed and circulated globally. Those dollars flowed overseas, financing trade, defense commitments, and international aid. But U.S. gold reserves were not increasing at the same pace. The number of dollars the gold backing them. Foreign leaders started questioning whether the United States could honor gold redemption promises. Some countries began requesting physical gold instead of holding dollars. As gold flowed out of American reserves, confidence in the system weakened. The imbalance between paper claims and physical gold became impossible to ignore. The Bretton Woods system was under pressure from its own structural design. The United States had supplied more dollars than it could realistically convert into gold. If every country demanded gold at once, the reserves would not suffice. American policymakers faced an uncomfortable and increasingly urgent decision. The pressure built steadily until the summer of 1971. Would hear an announcement that changed everything. Behind closed doors in Washington, officials debated how to prevent a financial crisis. The central question was simple but explosive: protect gold reserves or protect the dollar. Gold reserves were falling steadily as foreign governments demanded physical redemption. A decision was made to address the nation directly. On August 15, 1971, Americans gathered around their televisions. President Richard Nixon announced a series of extraordinary economic measures. Among those measures was a decision that would permanently alter global finance. The United States would suspend the convertibility of the dollar into gold. The gold window was closed, ending foreign governments' ability to exchange dollars for gold. The announcement stunned global markets and foreign leaders alike.
The carefully balanced Bretton Woods system effectively collapsed overnight. Markets struggled to interpret what this unprecedented move would mean. For the first time in modern history, the dollar was no longer anchored to gold. The global monetary system shifted from metal-backed certainty to policy-driven flexibility. Currencies began floating freely against one another for the first time.
Exchange rates were now determined by market forces rather than fixed agreements. Allies who relied on dollar stability suddenly faced uncertainty.
Supporters argued the move protected America's economic sovereignty and stability. Without gold constraints, policymakers gained greater control over money supply expansion.
In that single decision, money itself changed from physical promise to managed confidence.
The world did not collapse overnight, but economic pressure quietly began building.
Oil shocks intensified inflation, pushing fuel prices sharply higher across the country. For ordinary citizens, everyday expenses suddenly became noticeably more expensive. Groceries, rent, and basic necessities consumed larger portions of household income. People began feeling that their money simply did not stretch as far. Inflation in the United States surged into double-digit territory during the decade. Meanwhile, gold was no longer fixed at $35 per ounce.
Investors rushed toward gold as a hedge against currency instability and inflation.
By 1980, gold had risen more than 20 times its former official price. The volatility reflected growing uncertainty about the long-term value of fiat money. Attention turned toward the institution now responsible for controlling inflation. Paul Volcker became chairman of the Federal Reserve in 1979. He implemented aggressive interest rate hikes to break inflation's grip. Borrowing costs soared to levels unseen in modern American history. The economy slowed significantly as high rates reduced spending and investment. The recession that followed was painful but ultimately effective. By the mid-1980s, inflation had been brought under control. The economy gradually stabilized, entering a new era of growth. This period proved that fiat systems required disciplined central bank management. The anchor had shifted from metal in vaults to policy decisions in boardrooms. The decades after inflation control brought strong market expansion and financial innovation. Credit markets expanded dramatically as borrowing became central to economic growth. Government debt levels climbed to heights previously unimaginable under a gold constraint. Financial instruments grew more sophisticated, linking global markets together more tightly than ever before. Then in 2008, the global financial system faced another major crisis. Major financial institutions teetered on the edge of collapse. Central banks responded with unprecedented liquidity programs to stabilize markets. Trillions of dollars were created to prevent a deeper economic depression. This demonstrated the extraordinary flexibility of a fiat monetary system. In 2020, another global crisis tested the system again. Governments issued direct payments funded through newly expanded monetary policy. Central bank balance sheets expanded to levels never seen before. Money now moves globally in milliseconds across interconnected digital systems. For most people, money feels intangible and almost invisible. Yet behind those numbers lies an intricate system sustained entirely by trust. That trust replaces the gold that once anchored the world's reserve currency. The anchor shifted from physical scarcity to policy management and institutional credibility. Understanding this shift empowers you to think differently about savings and investment. The real question is not whether the system works, but how long confidence holds. The gold standard ended in 1971, but the story of money continues to evolve.